Well, hello, everybody. I'm Russ Tweiten, Vice President, Succession and Retirement Planning, and welcome to another edition of Transitions. Today, we're going to talk about transitioning machinery and equipment. Machinery and equipment is often the first asset to begin transitioning because it's very transactional. Every year, most farmers and ranchers are turning over some of their line of machinery, and so it becomes a very easy asset to work into the transition plan. Let's talk about the four different ways we often see machinery transition. First is what we might call the piece by piece. Under this strategy, if something is either worn out or needs to be upgraded or it just isn't working for the farm anymore, the senior farmer will often gift or sell at a discount that piece of equipment to the successor. The successor then trades it off, pays the boot, and is now responsible for that piece of machinery. You do need to be careful with this, because if it's traded off and the senior farmer still technically owns it, they're going to be taxed on that. So we want to make sure there's some documentation showing that that piece of machinery was either sold or gifted to the successor farmer. But by and large, that piece by piece strategy is most likely the most common way that we see machinery and equipment transition. However, if it's a larger farm, it's going to take a long time. So then we need to look at deploying a different strategy. The second strategy that we're starting to see more use of, and probably more than we expected, was when all or some of the machinery line is entirely gifted to the successor. And the way that's paid for often is to increase the cash rent. Gifting is a very tax-efficient way to transition machinery because it can be done tax-free for the most part. And the way it's paid for is by calculating, how much that machinery would have cost if it's sold, and maybe amortize that over 10 or 15 years and increase the cash rents. You've got to be very careful with this with your documentation. I won't get into all the details on what the rent contract should look like, but bumping up the rents is a very efficient way to transition machinery because rental income is not subject to self-employment tax. And so it's a very tax-efficient source of income. The third strategy is called an operating lease. An operating lease is often used when the senior farmer wants to generate income from their machinery line. You've got to be careful here as well, because there is a nasty tax trap called an installment sale. And under the installment sale tax rules, if depreciated assets such as machinery, buildings, a bin site, farm vehicles, if they're sold over time, like you might sell land on a contract for deed, all of the taxes are due in the first year of the contract. So let's say you put together a 10-year contract to sell the machinery, you're going to pay 10 years of taxes in 1 year. And so very few, if any, producers ever will do that. So the workaround is called an operating lease. Under an operating lease, the senior farmer retains ownership of the machinery and structures a lease for the successor. There's a 4-part test that the IRS requires be met that I won't get into, but one of the major components of that 4-part test is that at the end of the lease there can't be a bargain sale. So you can't say, okay, and we have a 10-year lease. In the 11th year, give me $1 and the machinery is yours. That will trigger the installment sale tax rules. Instead, there has to be a buyout. That buyout has to be a minimum of 15%. As long as the other 3 components of the 4-part test are met and that 15% test, you're going to qualify as an operating lease. So they've become very popular. They have really changed the way we structure retirement planning too for our senior farmers. For the larger farms, say we've got a multi-owner farm where there may be 4 or 5 brothers, or maybe there's 4 brothers and 2 cousins. They've got a large line of machinery. The challenge there is not every one of those owners is going to have a successor. So how do you get that person out who wants to retire when they've got an ownership interest in, say, a partnership or Maybe it's they just farm together. Well, the operating lease is one tool, but for some of the farms, we need to generate retirement income in a tax efficient manner. What we'll sometimes do is place the machinery, equipment, and to some degree the bin site and the buildings into a subchapter S corporation. And then when the individual retires, we'll have their stock purchased from them by the corporation. This is called a stock redemption and is a tax efficient way to have the individual purchase bought out, because the purchase of stock is subject to capital gains tax, which for many people is at 15%. Again, the S Corp idea is not used a lot. We generally will find more application to some of the large multi-owner farms. And so those are the 4 ways that we look to transition machinery. Thanks for listening today. If you have any questions, certainly get a hold of any of the individuals in the Succession and Retirement Planning Department, and we'd be happy to help. Thanks.